And welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. Gold is busting out. ETF trading remains robust. And despite everybody working from home, business is really good for the ETF business overall. And active management's also catching a bid on top of that. We've got a lot to talk about. We have three of the best in the business with us. Reggie Brown from GTS, Renato Legge from ARK Invest, and Harry Whitten from Old Mission Capital as well. Reggie, let me start with you. Gold's hitting all-time highs. Silver's hitting new highs as well. Big inflows into those large gold ETFs, even the stock ETFs around gold and silver. What's driving the interest? Is this just a weak dollar story? Is it a sluggish growth story? Is it an inflation worry story? Is it all of the above? What's moving gold so much in the last month?
Hey, Bob. Thanks for having me on again. I think it's all the above plus an additional one. So we heard earlier one of your panelists say that the dollar's hitting a two-year low. That means that the real interest rates are plummeting, and there's no risk for interest rate risk. And I think with the central banks around the world, with quantitative easing and printing of new currency to support some of the coronavirus rescue measures, I think we're seeing weak currencies across the board. But look, I think the biggest story here, I think you're seeing greater adoption of commodities, and particularly gold and silver, being put into asset allocation models. And I think that's, a new trend that we're seeing that's driving also the price of gold.
Yeah, that makes sense. Harry, you see a lot of trading. You specialize in trading and being a broker in the ETF business here. Even silver's rallying, the gold stocks rallying as well. I know silver has components of both industrial and a precious metal. Not exactly the same dynamics of gold, but very, very similar. Can you explain precious metals as well as silver for the same dynamics as gold?
Yeah, I mean, you look at the metals, it's just been in the last, specifically silver, the last couple of weeks, been going up to nonstop creation units in the ETFs, record volumes. I'm not sure if you saw this, Bob, but just last week, gold, GLD, IAU, and then SLV silver were three of the top five for inflows out of all ETFs in the industry. So it's being looked at by a lot of people. And there's more opportunity, people think, in silver. They think gold has run up a little bit higher. It's hitting all-time numbers, where silver is still way off its all-time high. So I think people think it has more room to run.
Yeah. Harry, Old Mission specializes in ETF trading and brokerage. That's what you guys do. Just generically, what kind of trading activity have you seen in the last few months? We've seen elevated equity trading volumes, elevated option and futures trading volume, a little bit, not as much in July as there has been perhaps in April and May. But what are you seeing in terms of ETF trading?
Well, lately, we have seen more equity volume probably over the last month or so. But if you go back all the way back to when the pandemic started, bonds have really been the king. More money has gone into bond funds than any other asset class in ETFs. Bond funds have done $85 billion in the second quarter versus equity funds $20 billion in inflows. So it's really been that's been the focus of what's been going on out there. I do know BlackRock last week just put out a number where they traded $5.1 trillion during the first half of the year, which is a record for them. So regardless of the product, you're seeing just record volumes all across the place. And if you really want to look down, something I found interesting, if you look at the top 10 year over year, last year's top 10, to be in the top 10, you needed to do at least $1 billion in net inflows. This year, the number 10 firm, which right now is Invesco, they've done over $3.5 billion. So just the growth of ETFs and the actual trading volume of ETFs has just been huge.
How do you explain the growth of the bond ETFs? I find a hard time with it. I mean, we're hitting new highs today on the corporate bond ETF, the main one, LQD. AGG, the broadest bond ETF I think you can own out there, is also at a new high. And we're getting ridiculously low yields on any of these. Is it because comparatively we still have yields and the rest of the world basically doesn't? I get this question all day long about the volumes in these things and the fact that it can't just be that the government is buying corporate bonds. It's broader than that, right?
Yeah, absolutely. I mean, the government actually has stopped buying the ETFs, at least they said they have, and they've released those numbers. You haven't seen them really grow that much. But AGG is closing in on $80 billion of assets under management. It's amazing. It's not only it's higher than before the pandemic, and it's at a record high. People are yield searching. Yeah. Another product that's out there yield searching are, BlackRock and iShares have the bullet share. BlackRock has the I bonds, and Invesco has the bullet shares, which are, maturity funds where they can build a laddered portfolio. And those are seeing record inflows also.
Yeah. Renato, I haven't gotten to you yet, but let me turn to you. It's amazing to me to watch the ETF business keep growing here. We follow the quarterly and first half numbers here. Doug Jonas over at the NYSE put out his first half numbers here. 2,639 ETFs, $4.3 trillion in assets under management. And he says 2020 is the year of active management. And we have 56 actively managed ETFs that have come to market this year. That's nearly half of all the launches. I've never seen that before. And, of course, ARK Invest, you're sort of the leader in the active space, at least active equity space. Is it too much to say you're the success story in active equity management this year? That ARK Innovation ETF you've got, ARKK, it's nearly $6 billion in assets. What do you attribute the success here? Is it you guys are a bunch of geniuses, you and Kathy Woods over there? Or is this the year for active management? Or is it the right kind of selection? Why are you particularly successful versus everybody else?
Hi, Bob. It's great to speak with you. We've had record-breaking inflows into our actively managed ETFs so far this year, and ARK now has 40% market share of all the actively managed equity ETFs, which suggests that investors want more than just active management. They want exposure to innovation. And as you know, Bob, we're focused on 5 innovation platforms: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, all of which we believe will create multi-trillion-dollar opportunities over the next 10 to 15 years. And these disruptive technologies are experiencing an acceleration in adoption in this current environment. And the companies within our ETFs are gaining significant market share and outperforming the broader market. So the disruption that's caused by these innovative companies like Tesla and Square are making it critical for investors to allocate to innovation in their portfolios. And we see this is just the beginning of this trend.
But it's no secret, Renato, that the reason ARK has been, the ARKK, your innovation ETF, has been so successful this year is you have a really big bet on Tesla. It's, 10% of the fund, essentially? You have very concentrated bets. So the question is this. Number one, you made the right guess on Tesla. Had you not, you wouldn't have been up nearly as much. But I think on a broader question, do you think investors want these kinds of concentrated bets? It seems like they actually do. There you see, look, there's 10% on Tesla, and Invitae and Square and CRISPR and Roku are very significant holdings as well. But this is a pretty concentrated portfolio. Is that what investors want? Reggie, let me ask you, do you get this sense of active management that they'll be successful if they make these kinds of concentrated bets and they live and die on whether they're right or not? Reggie?
Well, I think there's always a room for active management, particularly in an ETF format. You look at all the non-transparent ETFs that are brought to the marketplace recently. I think there's 6 of them, or 5 or 6. I think they're picking up speed. There's always room for active management, and particularly when markets reverse, and I think you start seeing the views of the active manager present alpha, I think you'll see a difference between active and passive. So just because ETFs are here does not mean that active goes away.
Yeah. But Harry, we get back to this old question. I know this is a little older than you and me, but is there really any evidence that active management outperforms passive management? I don't see it. Certainly not in the long run. Vanguard was practically founded on this idea that it can't be done. It's wonderful that Kathy and Renato are doing so well over at ARK on a concentrated bet, but they are a very small group of winners there. Harry?
Yeah, very true, Bob. It's the story has been for years how passive has outperformed active. And I like the ARK story. I've been following it for years. And I think others are going to come, and they're also following ARK. I know as a market maker, we get asked a lot of questions by existing issuers and new issuers, and they're all talking about ARK and what they're doing. And I think you're going to see more active managers come, and we're going to see if they really can do it going head to head. They've been shying away from the ETF platforms.
Right. And so the secret here, Renato, is really you have hit upon the right methodology for the times. Disruptive technologies that are altering the way we work. We now have a pandemic that is accelerating the way we work, that are benefiting the specific stocks that we had talked about as just what we broadly call disruptive technologies. So you're picking stuff in a growth area with a lot of disruption that's changing the way we work and live. I guess that makes a lot of sense. If you were working in another space, defensive or industrials, it might be a little harder to do that kind of outperformance that you're seeing here with your funds right now. Or is that a fair way to characterize this, Renato?
Yes, absolutely. I mean, we're focused on these transformational technologies that are disrupting and disintermediating existing sectors and industries that make up some of the ones that you just mentioned. And they dominate these broader-based indices like the S&P 500. And most investors have exposure to, those broader-based indices. So this is providing kind of your forward-looking exposure. The names, we have zero FANG exposure right now in our portfolio. These are the next group of FANG stocks we believe that will be part of the broader base indices. And it also serves as kind of a hedge against the potential disruption happening in those core portfolios.
Yeah. The other thing I note is you really are a little unusual in that you're the far and away the largest actively managed equity ETF. I guess the question here, and anybody can handle this, why is there so much more active management? We have ETFs like Mint out there, and the JP Morgan one's pretty big. But why is there so many more active managed bond ETFs than stock ETFs? Or is that about to change dramatically this year? Is it just harder to pick stocks than it is to pick bonds? Reggie, you want to take a shot at that? Go ahead, anybody.
Yeah, this is Renato. I'll comment on the non-transparent active ETFs. That's where we're seeing a big push on the equity side. And, we're fully transparent, but we think that asset managers that are coming on board and bringing those ETFs to market are actually educating the market on how investors can buy these actively managed strategies in a more kind of tax efficient and lower cost wrapper compared to mutual funds. So we think this will help accelerate kind of the transition away from active mutual funds to active ETFs.
Well, Bob, if I can jump in, I think investors just would like to just have the opportunity to pick the vehicle of choice, and the managers are going to deliver their views, whether it's for a 40 Act open-ended mutual fund or an ETF. Investors will have the choice vehicle to utilize. So I think that you always have the room to bring active management equity into the marketplace, and then that's what's been traditionally. ETFs are just catching up to it from equity standpoint. So I think you'll see a lot of growth in the active equity space utilizing either a transparent vehicle to deliver those views or a non-transparent view over the next, call it, 18 months or so.
Yeah. Harry, you're going to have the last word here. I gather you too feel that active equity is finally here to stay. I guess the problem I have is very simple. If you're a mediocre active manager in a mutual fund wrapper, you're not suddenly going to become a genius by suddenly throwing it into an ETF wrapper. You may charge lower fees. You may have a more tax-efficient structure. Even if it's non-transparent, though, it's not going to turn you into some kind of genius. That's my concern. ARK would be successful in a mutual fund platform because of the space that they're in and perhaps their methodology. But would you agree, Harry, that just switching to an active non-transparent ETF wrapper isn't going to change anybody's track record?
You're dead on, Bob. It's whether it's active non-transparent or active transparent, you still have to perform. And if you're going to be active, you're going to have to pick the right stocks. You're going to have to trade them properly. And that's the big difference. So as I said before, if they're going to come out with an ETF and they think they can do better in an ETF wrapper, well, they're still going to have to prove it. And it'll be great to watch, and it's going to be good for the ETF industry because more and more people are going to get into it, and it's going to be a lot more visible.
Yeah, I agree with that, Harry. Okay, thanks very much, guys. That does it for this week's ETF Edge. My thanks, of course, to Reggie, Harry, and Renato for joining us today. And remember, you can find all of our latest videos right here on our website here, etfedge.cnbc.com. And don't forget to tune into our podcast where we go into a little more depth on some of the things we're talking about, including active management and whether it really works in the long term here. We'll see you next Monday, same time, same place. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.